Hey, good morning, everyone. Pretty glad it's Friday, and I always like to start my Fridays talking about trend following with you guys. So it's great to be at it again. Yesterday was fun. I listened to the quantitative brainstorming, and I thought that was really good. I listened to the recording too of the prior week, and it's all good. I really enjoy hearing more from Derek and Richard and the Brunos and everybody else. So I thought that was really good idea. It's a great thing about Clubhouse is that you can start these things with talk about any topic you want to talk about, and anytime you want to start it. I think that Fridays at 9 a.m. is not the most convenient for everyone, so that's it's really helpful to see other people uh, pick up the reins and start conversations that suits them. Then also, I put on for a lot of people in the trend following club. I put on the notify that whenever somebody speaks, I get a notification. So if Derek is speaking or Richard is speaking or Bruno, I'm going to get notified so I can hop right on, if possible. So that's another good feature as well. Um, there was a lot of good stuff going on Twitter. One of my favorites was the Mulvaney track record and his performance, and I followed him over the years. And I actually had dinner with him right before COVID, I believe, in Miami. And I bought him a big steak dinner and big wines, but he did not agree to come on the trend following trading club this morning. So that's, then he has not committed to a date in the future either. But, I'm not going to give up. And if I have to remind him about that monster steak and wines at Prime 112, then maybe I'll resort to that to shame him into coming on and talking, because I didn't get a chance to speak to him a lot that night because it was a big dinner. And but I want to ask him some questions and stuff. And honestly, this is kind of a bad admission to make. I like to invest with other managers, other trend followers especially, and follow them and read about them and talk to them. And I wanted to invest with him over the past few years, maybe 4 or 5 years, and I never pulled the trigger. And my advisors would say, "Oh, he's down 20%. Do you still want to invest?" And I'm like, "Oh, okay, hold off." And so it got away from me, and I just, irrespective of his performance, I should have just put it in, right? And I didn't do it, and so now, oh well, uh, that's pretty bad on my part for not having my investment with him for a number of years ago. So, anyways, it'd be fun to talk about him and any other subjects that you guys are interested in. I'm perfectly willing to let it go where you think everybody wants it to go. But I think that his volatility, and I guess the ultimate question I would like, or discussion with him, would be something like, um, you know, given your performance is very good, but it has come with a lot of volatility. Um, does that bother you, and is that sort of a characteristic and a of making a lot of money? And obviously, I think it is that he makes this money because he's willing to sit there and let those open trades and open profits slosh around and be at risk of giving a bunch of it back. And he's ice. He's pretty cold blooded. I mean, he's got ice in his veins. He is way tougher than me, and I think it's evidenced by his track record in that uh, our friend Nick down in Australia called it ugly. It doesn't get much uglier than that. I thought, exactly. Is that some sort of beautiful ugliness, isn't it? I think that's what Nick meant. Well, maybe he doesn't like it, but I kind of like it. I think it's beautiful. I've just always been drawn to this guy because I think it's closest thing to classic trend following in practice that I have seen from anyone, basically, since maybe John Henry. Anyways, I'm opening it up to everybody else, so please feel free to raise your hand and come on stage.
Hi, Jerry. Hi, everyone. Glad to be here.
Hi everyone, as usual, we'll say that very happy to be here and very glad and very happy.
G'day everyone, great to be here. Jerry, I think I like ugly things, so I like bulldogs. So they're very ugly dogs, but they've got a bit behind them. So I can see what you're referring to with Paul. Interesting that last night with Derek's brainstorming session, Bruno brought up some very good points on Paul regarding his win rate, which I believe, Bruno, you're mentioning is about 20 to 25%. I know you wanted to say something about Paul Mulvaney's fund, so please go ahead.
Oh, sure. Perhaps I've pulled the trigger too early yesterday. And not the right forum. Here's the right forum. And in their website, there's an interview from 2004, 2003, not sure. And in that interview, they say that their hit ratio is between 20 to 25%. I'm not sure if that's the same through time. It's been a long time, since 2004. But in regard to their equity curve, that's pretty much the same through time. The same volatility, the same drawdowns, the same drawdown depth. I believe that it is. It might be between 20 to 25. And through when I look at my models, when I look at my systems, all the different possibilities, I get to that hit ratio when I go to very long term models that look at a very long breakout for entry, a very long breakout for exit, loose pants on the stop, to use Morit's expression. But and these models have the most positive skewness. They have they are amazing at getting the outliers. The win loss ratio is really high. But the problem, from my perspective, is that you pay handsomely for the losing trades, because they are too common. And I've heard Jerry talking about hit ratios around 30 to 40%, and honestly, I've defaulted to the models, to the systems that have that are in that region of hit ratio. But I'd like to hear from you guys what you think on this issue, on this this trade-off between hit ratio and win-loss ratio.
Look, I was mentioning last night how when most traders seem to think that there's a symmetrical trade-off between win rate and reward to risk, but I don't think that's entirely the case. So an example is, a trader that might trade a convergence strategy might have a high win rate, 60 to 70%, but to achieve that win rate, they're effectively making their profit outcomes linear or less than linear. So you get a reward to risk of maybe less than one in relation to the outcome of the profit. And there's this notion that people seem to think, because they tend to think linearly, is that if you therefore reduce your win rate to say 40%, you can accommodate a higher reward to risk in a linear relationship. So what many traders think is that there's this symmetrical trade-off between the two. Neither is better than the other. It's just an outcome of expectancy with the win rate and the reward to risk relationship. However, what I think they're missing out on is this non-linearity that exists in outliers, because what that non-linearity does is it totally misshapes symmetrical relationship to be an asymmetrical relationship. And I think what Paul's doing is he is definitely letting his profits run. In no way, shape, or form is he attempting to sort of reduce his profitability to achieve a higher win rate. He's going strictly for outliers. So the benefit is that even though he can get down to a very low win rate of 20 to 25%, and I think we could all agree when you have a win rate of 20 to 25%, you can't call yourself a predictive method. It's a price following method, because to be the loser 80% of the time requires intense faith in your method. But I think it's not a blind faith for Paul. He recognizes that there is this non-linear relationship. So he recognizes that letting profits run, these extreme extended or trends persistence, these extended profits more than compensate for any reduction in his win rate. So that's how he's very patient. He's obviously, many times he's wrong in his assumption, but he's always cutting his losses short. He does achieve these very volatile equity curves, but within that volatile equity curve, there's an asymmetry, an upside asymmetry. And that, over the long term, provided this is what Jerry was talking about, where your unrealized equity always sits above your drawdown, your realized balance. Because in this positive skewed context with this upside asymmetry, in the long term, compounding lifts that towards the heavens. And so Paul might have a volatile equity curve, but volatility does not equal risk. In this case, it's necessary to have that volatility to achieve these outstanding returns.
Yes, I agree with all of that. Actually, hypothetically, let's say I might be longer term than Paul because I can't really tell too much, because his volatility is a combination of long term, letting profits run to the max, loose pants, plus his chosen leverage. So, and I think Niels has expressed some confidence that he kind of knows the parameters. And I think I heard the parameters. I don't remember exactly what he said, but I definitely remember thinking, well, I'm longer term than that. So I think this 25% win rate thereabouts is totally due to the stop loss. So he has much tighter stops than me. And so the turtles used to use a 2 ATR stop loss or smaller. Whoa, yeah, it could be smaller than that. And then I did the back test research in 1988. Okay, and we settled on something larger than 2 ATRs. We optimized it out, and so we're a lot more than 2, but less than 10, let's say. So we're in that range, and so we optimized it out and we said, okay, we want to make the most amount of money, right? So 5, 6, 7 in this range. It doesn't sound like a small loss, but this is what the back test says. But then over the years, I've wondered and listened to other people say, well, it may not be the perfect way to do this to optimize how many ATRs to risk. It has your skew will be different, your win loss ratio would be different. So maybe you use a tighter stop 2, 3, 4 versus 5, 6, 7 in order to have more skew or a better win loss ratio. So that's the question for Richard and Bruno and other people. What do you think about that?
Well, Jerry, what I personally think when I compare Chesapeake's equity curve with Paul's, there is a strong correlation between both equity curves. And we're talking about, well, Paul probably trades with higher leverage. Yes, it definitely could be these smaller stops. So what he's doing is he's forcing greater asymmetry in his system design with very short, cut losses as short as possible, more than what we'd probably do, but let these profits run. That therefore creates this asymmetrical profile to the upside. But in addition to that, I think if we more aggressively compounded, so we've both said that we weekly compound, maybe we don't continuously lift our trade risk based on this progressive moving realized balance. We wait some time, and it's more a discretionary decision to slowly, more conservatively compound through less regular compounding frequency. So Paul, I suspect, when I look at the pogo stick returns he delivers, I suspect he's much more aggressively compounding as well. So when you see his equity curve since, say, 2000 to current day, it sort of takes a fairly linear sort of upward slope. But then you start seeing this sort of, it's a bit like a magnifying glass, this magnified leverage start taking hold in his equity curve, where he gets these spectacular booms and then he gets these significant drawdowns, and you get this sort of this pogo stick effect, which is a consequence of your aggressive compounding. But, I think when you're going for gold, like Paul does, when you're going for the heavens, trying to hit it out of the ballpark, I can totally see why he's doing that. The only thing I worry about is that compounded nature, that maybe if it is aggressive compounding, that compounding nature can be detrimental in some instances. I think Paul's definitely got his head around it, but I certainly don't have the fortitude to maintain that level of compounding frequency or leverage, whatever it is he's doing, with that aggressive volatility.
Oh yeah, I forgot about that. That's exactly right. He could be updating his trade level as he's making profits and trading the new trades, or at least the new trades, with this accumulated open profit. And just to remind, so I combine this. I try to have this lack of regard for volatility as relates to the open trade profits, and so I look really crazy, and my volatility is fluctuating a lot. No vol targeting, no take profits, no scale back, no money managed overlay on top of the portfolio. So I combine that with very conservative methods of increasing my trade level. So I'm slow to increase it on the way up with open profits, but I'm very quick to reduce it on the way down if I'm losing money. And combine that with craziness as far as letting the profits run. I think that's why. So I talk a big game about let those profits run, but behind the scenes, I'm being a bit conservative with my potential losing trades. I don't want to put on trades in January that are going to be at a trade level of 1 million, and then halfway through the year, my trade level is now 2 million, and those trades are much bigger than the ones in January. Even though I still have those on, I want my bets. I'm betting, and I want my bets to sort of be the same for what seems like an extended period of time. Good news. We have Jacob, I think, and for the first time, and we've been trying to get him on, our friend from Twitter, and I think Australia, maybe. But he's been invited, so get up here, Jacob.
Jerry, just want to address your question on the breadth of the stop versus if it's too wide, it's not a small loss. From where I see it, and well, I have to be cautious here because I don't want to teach the Pope how to preach, but from where I see it, if capital is not a problem, simply from the system's point of view, you can calibrate the size of the loss through the unit size. For example, if you trade 4 ATR stop, that would represent, I don't know, a loss of 1% of capital. But if you identify that the 8 ATR model is better, you can reduce the unit size by half, and then if you lose money, you will lose, well, 1%. But if the system is better, it should perform better. The only problem again is the capital constraint, because if you're too small, a unit size half of what you had may represent not even one contract on these big markets.
That's right. You know, the small loss can be the 50 basis points, 25 basis points, 1%. That's right. So you're totally in control of that. But if the ATR stop is 10 ATRs or 20 ATRs, you know, you're not really taking a small loss from the trading point of view, even though, oh yeah, it's a small loss in terms of capital risk. I just wonder though if there's some efficiency that I'm losing by optimizing it to the level I'm at now versus trading a suboptimal ATR, 2 ATRs, 1 ATR stop loss. You know, it's just like I'm reminded of what Richard taught me months and months ago about, like, these stops are great because they get us out of these positions. We're no longer warehousing this risk. I think it's something like that. And I was like, oh yeah, okay. So you want to have these stops so you can reduce your risk and move on to something else and have less risk all the time because you're, and so, but so if you increase that stop and optimize it, you're keeping these positions on longer and sort of going against that philosophy of warehousing the risk.
Okay, I wanted to say that I saw in one famous font in the site of the font that the rule is 1% risk on a trade. Yes, but it's a short-term font, and they trade actually maybe a few trades a week, maybe even intraday trades they accept, and it's a very big risk when we trade 1% in a day. If we lose to theoretically average 1% in a day, we can lose a lot of money. Really, we can lose all account, in fact, when it will be a bad period for the system, for the strategy. So position sizing is a very big part of risk management as a whole.
On the subject of finding optimal position size, what's your opinion, Jerry and Richard, about sizing different markets differently, meaning having different ATR multipliers depending on certain asset classes or certain characteristics or certain instruments, or is that a big no-no and everything should be set exactly the same, or are there some reasons to effectively size risk differently in different markets because they tend to move not so much in terms of daily pricings, which is caught by the ATR itself, but they tend to gap less or more, or be more orderly or less so.
Bruno, just my perspective is that I use ATR basically to in conjunction with a fixed dollar risk. So at any point in time, I'm applying the same risk bet. Maybe let's say it's $500 per trade. I'm using ATR to determine to normalize my initial stop, my risk across any of these markets. Because if I chose a different method where I applied a greater position sizing to one market than another, I'd have to have a fundamental reason for doing so. So that reason for doing so would be that I consider that there is more trending opportunity in one market than another. Now, of course, my foundational principle is that because I'm going for these outliers, which are these nonlinear anomalies, effectively, which we can't quantify, why would I have that opinion? The only reason I'd have that opinion is if I thought, well, trends are more prolific in a particular market. So I tend to not have any assumption regarding an individual market's trending potential. I treat them all equally, and therefore I apply an equal dollar risk. So why do I trade? So $500 might represent 0.5% on my particular equity at a point in time, or 50 basis points. Now, ideally, if I could trade $250, I would do so, because with my finite capital, by trading $250 per market or per system, that forces me to diversify wider. And that agrees with my principle of let's aggressively hunt for these outliers wherever they exist. So the more I can diversify, the better it is. Of course, there's, the broker restrictions. The reality of practical trading is that there comes a time where there is a finite limit. So I try and make sure that I'm trading everything the same size, but getting as small as I can. This 1% that Oleg was saying, clearly far too high for my likes. Because if I've got a 20, 25% or 30%, 40% win rate, I've got to expect 17 consecutive losses in a row, 20 in a row. So the smaller you go, of course, the smaller that linear drawdown sort of develops. But so that's how I view it. But I'd be interested to hear how Jerry does it.
Yeah, I do it the same way. I agree with all of that. I definitely would not implement any sort of experience or back test. I would not even try to back test. And I do a back test that assumes some of the markets would be better suited with longer term, shorter or longer stop losses. That's sort of a violation of treating all the markets the same. It's the old Richard Dennis idea. I'll trade the market. I can cover up the name of the market, and I know how to trade it. It's just, once again, back to sample size and robustness. But for unit size and my commitment to how large I'm going to trade each market, that's totally based upon my analysis of the correlations. And I don't want to do any in-depth analysis. If it sticks out in a big way, that, like, I have a group of markets, like 15, that are unlike all the other markets: palladium, iron ore, emissions, nat gas, Bitcoin. Okay, so they're going to get a fixed unit size that I'm going to hopefully trade for the rest of my life. It's going to be a bit bigger than wheat, corn, and beans, which I think are kind of very similar. And I think, even though I would not optimize the corn stop loss or the corn exit trailing stop or the corn entry breakout, I do think it's a good idea to trade, like my system 1, that may have a 5 ATR stop. System 2, it'll have a different entry, a different exit, and then it'll have a 6 ATR stop. And so I'll split the capital up evenly between each system, and I will, for diversification reasons, use a different stop loss with each system, possibly, but I'm not going to optimize per market. And then, of course, as I've said before, all of my systems within this wide range of parameters, they all make about the same amount of money in the back test.
Jerry, quick question here on this topic. If how fast does this unit size change? I mean, if you see that things are starting to correlate, do you reduce the size of the next trades, or no? This is a decision made once in a while. Ideally, only when you incorporate a new market on the system. How fast is this so-called update?
Well, I didn't mean to give the impression that I do much updating. When I first add a market, and most of the markets I've been trading for 30 years, or, well, a lot of the markets, So then when they come on, I try to make a guess. It seems if it's very obvious, then I think emissions is one, and nat gas is not necessarily correlated with crude, heating oil, and unleaded, which are all correlated. And so I just try to ignore it. I used to obsess about it, and then Richard reminded me, let's hunt outliers. And an outlier can even come from heating oil, which I've experienced. I've said this many times. I've made a bunch of money in heating oil in 1984, and then in 1990, heating oil doubled and crude and sort of sat there. And so I appreciate the and I try to achieve a lot of diversification, but I'm not obsessed with it. I used to be, and then now I'm obsessed with these outliers. And we see it all the time. Something crazy happens in copper or zinc, and it's just this crazy thing that we never thought about. And so I think, and you can get away with this sort of imprecise correlation analysis and not obsessing with it and not adjusting your trades and positions contemporaneously based upon increased correlations, the more markets you trade. So I'm up to 130 and I'm going to 160, hopefully. And so, okay, I'm trading crude too large. I should pay more attention to crude, heating oil, and unleaded if I cared about Sharp, which I don't, of course. But how I'm trading those markets so small. They're 3 out of 130, equal weighted mostly, except for those 15 that are overweighted. Okay, so I made a huge mistake, but it's not really manifesting itself very much. So once again, there's many different reasons. Richard mentions a lot of them to trade as many markets as possible. And then this is another one. It's not that I don't care about volatility. I don't care about Sharp. I don't care. I don't like waking up in the morning and seeing getting devastated, right? I don't like that. But it's just cannot be my bottom line. My bottom line is suck it up and hunt the outliers. And then, like we saw in February of last year, all the analysis that you could possibly do, historically, back test, if you guess correctly, there was nothing you could do. The problem was your longs. And we had a lot of longs on. And that was the whole problem. All the longs went down. And you're like, and so that's one of the first rules I learned in 1983 was it's better to have longs and shorts on. You mean in energy? No, no. Sometimes the longs all go down. Sometimes the shorts all go up. And it could be currencies, commodities, stocks, and bonds. It is, and so it's really nice to have some shorts on. And we didn't have enough when COVID hit. And that's when we're scrambling to get out of the longs and get into the shorts. And then the shorts were the only thing that were working, for a long time.
Thanks.
Yeah, I think correlations can be as fickle as price itself, like vague periods of correlation, periods of uncorrelation, periods of anti-correlation. I think what we've always got to keep in the back of our mind is that when we're dealing with price of any instrument, we're not dealing with a single instrument. So when we say we trade corn, or when we say we trade soybeans, or when we say we trade platinum, it's a bit like if, for instance, I put a rocket ship on a blackboard, I had a totally blackboard, drew a rocket ship on there, and I said to you, what speed is it doing? You'd say, well, I can't tell. Relative to what? And it's exactly the same as price of any instrument. There's a relative relationship between the price of that instrument and something else. So when we say we trade soybeans, we're probably trading it in US dollars. When we trade corn, we're probably trading it in US dollars. When we're trading platinum, we're probably trading it in US dollars. So this relationship, this relativity between that instrument and the underlying denominator that you're trading in, I think that is the major dominant reason for this moving correlations. So, when we look at the stock market and we say, why is it that stocks all become positively correlated when we're in a bear phase? And I think that's because of availability of liquidity. It's not the stocks themselves, the Amazons or whatever, it's the actual dollars, the availability of dollars to that firm. And it's the same as, why do we find this period of growing correlations post 2008 with this intense quantitative easing programs that flooded the market with US dollars, trillions and trillions of dollars of US dollars, that forced this corn, soybeans, everything, all these financial assets to become far more highly correlated than what they were pre-2008. So I think we've got to be careful when we are choosing instruments that we always ask the question, price relative to what? Because what you'll find when you look at your portfolio is that you're probably incredibly weighted towards US dollars. That will force correlation into that portfolio, which can be negative to you. So I think Harold De Beer from TransTrend had a very good idea in it, and this deliberate construction of portfolios that are uncorrelated because you're consciously looking at that denominator and changing it. So trading in different currencies, breaking that correlation. I think that's important for trend following because this moving feast of correlation, whilst it can be a significant windfall for us when it's positively correlated to our windfall, but when it's negatively correlated, that's where the drawdown profile comes in. So, and it can become non-linear with building correlations. So I'm always worried about correlations, and I think that we've got to remove this notion that we have control over correlations, but you can be selective in the type of markets that you trade, and maybe not look at the available markets, but construct your own markets through ways to sort of put different products together into your portfolio that break that natural correlation that might be a domination of a certain currency, etc.
It sounds a bit contradictory, though, to finding the outliers your bottom line, and the idea that you should trade all of these different markets that seemingly are correlated because they're not the same market, and then you will get an outlier there that that you'll regret missing if you just. And you mentioned this on a podcast, and it was crude oil, West Texas versus Brent. And so when you mentioned that, I added Brent, and I was like, oh yeah, he's right. I'm going to add Brent back and gas oil, because I have been trading. And I admitted that when Arthur spoke on the Clubhouse months ago and said, hey, Jerry, you should reconsider trading the short-term interest rates, Eurodollar, short sterling, Euribor, Canadian bankers' acceptances, and Aussie bank bills. He said, you should consider adding those back because they're different as well. I added them back, and now I got all this profit. So
I think that's valid, Jerry. That's definitely valid, and but I think we perhaps could do better by logically thinking, well, in trading Brent and trading crude, let's trade Brent and crude, but let's change the underlying currency. So how would we do that? We'd have to synthetically construct something that allowed us to alter the denominators of each. So we're not sacrificing the outliers. We're saying Brent or crude could have the outliers, but it could be the underlying currency as well that could have the the outlier. So let's diversify wider by choosing a different currency base for Brent than we do for crude, if we can. So that's just what I'm meaning.
Oh, I like that. Yeah, that's very good. I also added back, after many years, I added back some of the cross currencies, um, Euro, Aussie, Euro, Canada, Swiss yen, sterling yen. And so I've enjoyed adding those back. And then I know on one episode you mentioned not trading, I don't know whether it was Aussie Canada or Aussie New Zealand, because they're sort of correlated, or they're sort of
Yeah, bad mix when they're
united.
together.
Yeah,
when
yeah.
they're both together, it's nasty.
Okay, so I ignored that. And
Uh,
that's sort of my hallmark, is that I listen carefully to smart people,
Name on one
and
instrument here.
and then I try to turn it into a philosophical point, a rule that will last forever. And and this is what I try to do. But with Rich, he would come up with these rules, and he'd say, "This is how the world works. This is how trading works." And I would just say, "Yes, this is great. I'm collecting all of this philosophical knowledge of how to proceed in the future." And then Rich would not do that, or he would kind of change his mind a bit, or throw in maybe an exception. And I would say, "No, I'm not going to go with that. No, I'm going to stick with these tried and true principles." So I'm kind of, my personality is like, Richard told me to don't be so concerned with correlation. That's exactly what Rich told me in 1983 as well. And I kind of forgot about that and got more interested in this portfolio that paid more attention to correlation. And so I'm sticking with that. And I don't care what he says about Aussie Canada, Aussie New Zealand. I I'm going to go with that. So, and I just want to throw in one other point back to correlation, and that is, in all of these trades, when you're long, whether it's a sector and they're all going up, or currently when all the commodities are going up, I think that it's inevitable that these correlations are going to increase. You're making money, so I feel like I can ignore um, and not worry so much about it. I have all this built-in profit. I'm kind of happy that all of my decisions are succeeding. And I think looking at correlation this way is not as helpful as understanding and looking at historical trades and saying, you can have two markets that are highly correlated over a period of time, and one makes 10 ATRs and the other one makes 30 ATRs. So the correlation of the final P&L is much, much different. And I think that should carry a bit of weight. And the way to handle this correlation in the meantime, during these trades, when everything's working or everything's going in the same direction, is I'm going to default to my how much am I risking? What's my max unit size? My maximum risk budget, and I'm happy with all of that. And so, even if things get a little dicey, and I do have a bit of volatility, and the correlations increase, um, my risk I got my risk budget where I liked it, months ago, year ago. I'm not going to scramble today and say, "Oh gosh, now I realize I'm trading too large. What am I going to do?"
And I want to say that I like the point of Niels that there's a correlation between negative correlation, as I remember, between when stocks goes up and another something. It's more good now with my network, something with the internet. When stocks goes up, Niels said, and bonds goes down, and it will not be every time. It will not be every time. And for example, he said from 90 to 1920, it wasn't so, and it will not be so. So it's very dangerous to invest in such a way in a 60-40 portfolio. I mean this, but I had a problem with my equipment or maybe with internet, so maybe it's not very clear what I said.
Yeah, no, I agree with Oleg there. I think the days of the 60-40 portfolio are probably numbered, and I think there's going to be a mass wholesale shift away from that that recipe, which I suppose provides significant opportunities for those perhaps those alternative asset classes, perhaps trend following. So to pick up some of that slack that the bonds might have given over the last 25 years with this sort of negative cushioning to equity. So if that evaporates quite clearly, I think there'll be a new solution developed, probably a simple solution developed for the mutual industry, etc. But it might not necessarily be the 60-40 equity bond portfolio.
I was getting a little and listening to Derek's quantitative brainstorming yesterday. I was writing down some comments and questions, and I was wanting to. One of my conclusions that was that a good question would be: should we be worried when everybody starts to agree that they should be divergent? You guys are making such a great case, as we do here as well, about divergence being so much better than convergence. And I got to be worrying that, well, what happens when too many people start agreeing with us?
That's where we've got the golden ticket, Jerry, because remember we said that in our land of trend following, there's positive reinforcement. In the land of convergence, there's negative feedback. So positive feedback, negative feedback. So the more people that become trend followers, the better it is for us because it amplifies our signal. But the more people that become convergent traders, it destructs that edge. It eats that edge. There's arbitrage from that edge. So I think that at the moment the odds are very tilted against us. When you look at the fund managers, the professional fund managers, you'll probably find I've seen tables of this. It's about 93% convergent, 7% divergent. So that says that we are significantly outnumbered, but that outnumbering means that when convergence is wrong, there's this mass transfer of wealth over to those people. That's 7%. That's that Pareto principle in action. And that's probably why, in the long term, we're going to do exceptionally well. But we've also got this benefit that the nature of trend, the persistence of trend is based on this principle called serial correlation. And that momentum we talk about, or that persistence, is this amplification caused by positive feedback loops. So reinforced by synchronized participant behavior. So the more people that are doing trend following, the more it synchronizes towards sort of enduring trending opportunities. You've got more buyers. It's forcing price up, or more sellers, forcing price down in a positively correlated way. But the opposite is the case with convergence. So I think it's great for us the more that come along with us.
I'm sorry, and what do you think if all people? I don't really know I don't know the answer on this, but if a lot of people, a lot of fund manager will have profit from trend following, will be trend following effective in the same way? Will the performance will be the same, if so or not? I remember that Niels said, not about the subject, but very interesting topic, that it was not trend followers maybe 100 or 200 years ago, and now it's a lot of trend followers, people for trade, and trends exists, directional volatility exists, and maybe what do you think about?
Yeah, I'm very happy that willing to accept your explanation, Richard, that it's much better than what I sort of grew up on, which is fearing that there were too many trend followers. So I'm very happy about that.
And more to this point, I think the one of the edge, or the biggest edge, this strategy has over convergent trades is that it exploits behavioral weakness. And you guys, you Jerry, you Richard, even compared to somebody like me, are the prime examples of this. You're willing to sit through the volatility because you don't care, because because you made assumptions like there's a difference in equity, and so my open profits, they can do whatever they want. They're just not my money; they're the house money. So this gives a defined behavioral edge, which can't be arbitraged away with market strategies. It takes guts or some other attributes.
And it's really just selfish because we wouldn't do it if the back test told us we shouldn't do it. And we just are, and in some ways we're ignoring more common sense people in the majority by just saying, I can make more money if I convince myself that the problem that with this strategy is those losing trades. Take those small losses, and they can build up, and they can create their own type of drawdown. Especially if you, like I used to, trade too large and trade and have a really short stop. So we're just like taking advantage. It's like we have this note from the teacher that says we can skip the class that everyone else knows that you should not be skipping. But we're going to take this shortcut and convince ourselves theoretically that, okay, I can break the rules if I just convince myself risk equals that losing money, those small losing trades, and it's 60%. So that's a big number. And then the profitable trades I will handle much differently. I'll let those run. And the computer says, hey, you know what? You're going to get an A plus. You're the person who's going to get the A plus by doing this. Everyone's going to tell you you're cheating and you're not playing by the rules, and you should pay attention to this open trade equity. But the back test says, you know what? If you do this, you'll make more money than all those guys who are really following the majority's rules.
I'd also say that there's been training involved, Bruno, in getting this hard, thick exoskeleton that I currently possess. It's been about 30 years. I dabbled a lot with convergence, progression systems, etc., for about 25 years of my life, and just recognised that at the end of it all, it was a futile exercise, and that's where I had to look at a different way forward, and that's where I came upon the likes of Jerry, then the turtle traders, then the trend following philosophy. And it comes from me personally from the school of hard knocks. I realized that I can't beat the market, but I can float with the market. And my whole philosophy changed. It's sort of an acceptance of these principles that the market is always the greater being, and I'm just a little participant in that market. But there are certain things I can do to manage my risk at all times, and I float with the market and just take what the market gives me. So it is a philosophy. It is effectively a religion to me, even though I try and explain in very precise ways why, I'm not a fundamental, but I certainly am a fundamental when it comes to trend following. But I can see what you're wrestling with. I certainly understand it. I've had similar issues. I'm always trying to I was trying to outsmart it, think better, thinking that my research needs to be honed and improved. But yeah, I just had to let that go.
Hey,
But
Richard. Oh, yeah.
I'm still prone to jealousy, and like the next big drawdown, and the next big time I give back a lot of open profit, I'm going to go, why did I listen to Bruno? Should I improve my system? Everyone else is improving their system. So we're still bombarded by these feelings and competitiveness of other people who are taking profits and who are vol targeting. And we're like, well, wait a second. Am I right? I think I'm right. And I've had the hard knocks too. And the hard knocks have come back that whenever I deviated from just letting those profits run in some sort of real simple way, I've regretted it because I haven't made as much money.
I was gonna ask if Richard had a specific like that change, that switch. Do you remember exactly like kind of what happened that day, like a specific time, or is it too far?
No, it was in 2012. I was running a small fund with a few other partners of mine, which came from the business I previously worked in. It was a closed fund just to close net investors, and we're trading a progression-based system that I'd applied the spreadsheet, and it was a fail-safe. I thought, oh, you can't lose in this opportunity. We'd trade 24 hours a day. At that stage, we were discretionary. I was trading an 8-hour shift, and my two other mates were trading the other 8-hour shift components. We're switching around to the midnight shift, etc. So we're trading sort of a rules-based process in a discretionary way with a progression-based system. And it just dawned on me, what the hell am I doing? Because the fund got nowhere, the wheels spun backwards. Luckily, we were able to get out without affecting our investors too much. So we did a good thing for our investors. We protected their money, but we pulled the pin. And it was sort of like a tabula rasa moment for me, where I realised that I had to wipe the slate clean, go back to the fundamentals, piece it together in my brain, because the knowledge was there in my brain. I just hadn't pieced it together in a coherent narrative. I was all over the shop. So that sort of coincided with this intense sort of interest in the physical sciences. So I did a lot of reading, looked at a very interdisciplinary manner, started thinking, well, rather than go down the specialist route, let's go down the polymath route. Let's get a wide understanding of systems across biology, physics, chemistry, financial markets, and working on those principles, I started putting on my own terms a coherent narrative together from the fundamental basics of what are these things we call systems. And it just came to me with the more reading, the more understanding. It wasn't a case of reading white papers, it was a case of reading books, good quality books across interdisciplinary fields. And it started just clicking together. And that sort of developed the passion. It developed the yearn to sort of continually understand more, dig deeper, look at trend following, read all what's about trend following, but dig deeper. Try and find something deeper to trend following that gives it more significance. And so that's sort of my path.
Okay, I find it interesting how these two concepts, if you really look deep, and maybe that's too deep for this conversation, but if you look into life, how you have these where these both strategies almost link into life, also play a role. You have moments where everything just seems to be normal, and then suddenly there's a pivotal moment that just changes your whole life. And I see that as a fight between, well, not per se a fight, but just imbalance, or moments where one part. So you have the convergent moments in your life where everything is normal, and then you have those divergent moments where your life will never be the same and everything changes. And usually, what I notice for myself is when the divergent moments happen, those are the ones that really stick out. Those are the ones that we remember. And I guess depending on your philosophy or your mindset, you might revert, or you might focus more. You might tend to be more closer to one or the other mindset. But it's quite interesting how you can apply the same principles, in your life as well.
Do you
Yeah.
think this is a huge metaphor with trend following and what we do through our strategies? Because these pivotal moments you talk about, Jeffrey, they're only recognized exposed. We have a lot of small, potentially pivotal moments all the time. And what we should do is make small bets. Try to take as much potential pivotal moments as you can, so that one of them might be an outlier and change your life.
Very true.
I get a lot of inspiration, for instance. I consider what we're doing here in Clubhouse now research for me. So I would prefer to spend my time discussing concepts with all you guys, getting your points of view, because in that process, what I'm doing is in my brain, I'm stitching together important comments that people are making to create my own narrative that gives me a broader understanding, perhaps from a different perspective. So the more I look at problems from different angles, I think that you're looking at things from different symmetries, and these perspectives or these different symmetries give you an appreciation of a deeper underlying fundamental notion that you might have been hidden in plain sight right in front of your nose, but something that one of you will say will suddenly hit me like a brick. A light bulb will go on my head, and I'll remember that. I won't necessarily remember a swat of text in a white paper, but I will remember a comment that someone says. So I consider this the research function, and I prefer to do it in this collaborative dialogue way. Sort of going back to the days of the philosophers, I think that by this dialogue, our learning unfolds, and we get a much higher understanding of what all of these facts are in our head that are dribbling around and loosely connected. We need to create these greater connections and create this more greater narrative that's not just trend following the financial markets, it's connecting the entire dots of our universe, if you know what I mean.
I forgot to say one thing that came to mind as well. Those outliers in your life. When they are divergent, and I'm trying to implement the words that we use, but when they are really life changing, they're very hard to change, and I'm not able to piece it together right now, how that relates to why we are looking at outliers. Well, I guess those are the ones that stretch the most, but we only know that after the fact, right? But just in terms of life, those divergent outliers, they're very hard to change. Whereas the ones that are, the convergent items, so the normal things, the normal routines, they are the ones that are easy to change. That was just something that came to my mind. Not sure how.
I have said a lot of times that I'm absolutely sure that laws which we use in our trend following programs, in our trend following strategies, that laws are universal. And I saw even traces of the rain on my window maybe 1 or 2 years ago, and it looked like a chart, for example, of USD Canadian dollar, for example, and all the charts look very similar. And I have said before that when I look at the weather chart, I see the same laws working. I saw that maybe in April in my region it's maybe +8 degrees by Celsius or +12 or +5, and after that it in May it's become in 1 or 2 days +25. So it's the same that Richard said that +1 -1 +1 -1 +2 -3 +20. It's the same law of nature, and I see it in psychology of the people. I see it in nature. I see it in the mountains. So I love transforming, and transforming gives a lot for a person to be. If you're a transforming trader, if you're a researcher of transforming trading, you are absolutely sure you grow like a person, like personality. I'm sure it is so. It's my point.
Hey guys, I'd like to shift gears here a bit and get more technical again. A couple of weeks ago, Bruno P. Enticed that debate about open equity versus closed equity, and how does that relate to our sizing of positions. And last week, Derek recommended me a paper from Old Peters on the ergodicity problem of economics, and that the way economists look at problems assumes ergodicity, and most things, or many things in life, are not ergodic. And that clicked on my head, that debate of open equity versus closed equity. And what I mean is, if we size our positions based on open equity, sometimes we have a huge trade that drives our open equity up, and then we size the next trade based on that open equity. And because our hit ratio is so low, it's more it's pretty probable that that trade will go down. And if you're sizing your trade based on your open equity, you're taking a lot of risk. Whereas if you were sizing based on your closed equity, it wouldn't be that small. So if you align a lot or too many losing trades based on open equity, you may get hit too much, and then you will be on the thickest of your drawdown when finally a winning trade appears. But because you are sizing based on your open equity, the size of that winning trade will be small, and will not be may not be enough to pay you back all that you lost over time.
Brilliant,
Now
Bruno, and I'm glad this is being recorded. That's great logic and action there.
yeah, and when you go on when you size all your trades based on closed equity, when that winning trade finally hits, you get back all the money you lost on the line of on the sequence of losing trades. So I'm sorry if I sound a bit confused, but what I'm trying to say is that that game that all Peters uses to describe the problem of ergodicity in economics, I think it's a perfect example of what we see through our systems, our trend following systems, and it makes a lot of sense to me, and why it's better to size trades based on closed equity. Does it help at all, Bruno?
Well, I have a few answers, and it goes in all sorts of different dimensions and layers. Now, you guys know me a little bit more. When I bring up something, it's unfortunately a stack of problems, one on top of the other. So yeah, I completely agree with your logic and Richard's comment, the way you presented it. However, the way I tried is completely different from that. I don't want to give the idea that I keep compounding. Effectively, this is compounding every time, every day. And so every day you restrike your positions and your equity. And in that case, you're absolutely right. I wouldn't do that. It's quite risky, as you said. But what happens in the context of the way things work in my world, you have to sort of ballast. There's a big ballast on the other side, which is these continuous signals. Markets give you signals that are changing all the time. And I know that Richard made a point that said, oh, yeah, but continuous signal is effectively pyramiding. So you keep building up your position. Again, your point, Bruno. At the time when brought up this critique to using continuous signals and merging the equity in one account, I sort of kept quiet because the difference is quite fundamental to me. But what happens in real time and in real life in my systems is that, once again, Richard is right. If I were to keep reinvesting and compounding, I would be again pyramiding and sort of effectively turning a positively skewed system into a negatively skewed one, and a convergent trading a divergent strategy into a convergent strategy. But I don't do that because the way capital is calculated in a continuous world, and the reason why I use volatility, and by the way, I take Jerry's main critique to using volatility, is badly measured. So that's why I always, and again, Bruno, I hope you understand why I'm obsessed with finding a better measure of volatility, because it depends, it rules effectively how much risk you can take in this framework. And the reason why, the way I do it is to counter the pyramiding problem. I sort of look at markets and say, okay, how much volatility does each market realizes? Because you can have you can measure your ATR or your volatility, but then not all markets realize that ATR at any given point. So you have to make adjustments, and you have to see which markets do and which markets don't. And so in scaling up your signals and using this continuous scale, you have to pick a point. The top of your scale is effectively one full position. When you guys get your breakouts, at that point, our positions match. Before, our positions don't match. So I don't know if I explained it very well, but instead of building the position up at once, as you guys do, I keep building it up and doing that gradually when market moves in my favor, and sort of cutting it more aggressively as markets move out of my favor. And I temper that with signals strengthening and weakening, because the market could become more risky, but your signal could keep getting stronger, in which case you won't aggressively cut your positions, and the market could become risky, but your signal should take you out. It should become a little bit more faint, so that as well takes you out of position. So it's a very it wants to be a continuous effort. Using continuous signals, using volatility to size up your system is not just doing value at risk and changing your positions because a model tells you. It's just I think a slightly different framework. Imagining the system, imagining our trading on a continuous scale, and that sort of shifts the perspective a little bit. But I just want to make one point very clear. We might be talking different dialects, but we're talking the same language. I don't want to turn a divergent strategy into a convergent one. I don't think that what Jerry, what Richard, I mean, who am I to criticize? And you can't argue with success, and you never argue with success. So I'm not trying to come up with something better. I am, trying to, as Richard was saying, distill Jerry's superior thinking and trying to understand how he does things and whether I can apply it in my world. And in our conversation on Thursdays, or quantitative conversations, try to be a bit more effectively detailed about models and things like that. Why do I think I sort of have a chance, or small chance, at figuring out this problem? Well, again, MCMC and Bayesian inference. I think that gives us a little bit of an edge. But I said it before, Richard and Jerry will make more money over time. I'm trying to kind of make the journey a little bit smoother and sacrifice some of the upside. I know it's not something that everybody accepts, but that's a choice that you make, like everything in life.
Yeah, just to maybe one thing is not exactly clear for me. When you talk about resizing the position, is it solely because of new signals? In just to use a jargon that's perhaps forbidden here in this forum, new signals that enhance the expectation of winning in this trade, or are you resizing based on volatility because of risk?
Third choice, both. So perhaps we should, if you're interested in some of this philosophy, there's books, and I can point you out in very good directions. There's great resources in Neil's podcast, because what Rob Carver speaks about, and it's wonderful hearing listening to Jerry and Rob debating on this point. It's fantastic. But if you want one of these Thursdays, we can actually dig deep into how this thing works if there's enough interest. But yes, you do both because you have a signal coming from your signals, and it's not a play on words. Think about a MACD type strategy, or think about having a breakout in your in your world. That's a signal, and it can become more or less strong as the markets moves on. And volatility sort of scales up and down the amount of capital that you should allocate in order to realize an expected value or an expected profit. And where is the expectation coming from? Well, this is set at the outset. As a trading strategy, I would like to get this much out of the market. So yes, it's two things at once. The market gives you better signals through more precise measurement, i.e. less volatility, or it gives you better signals through a more divergent phenomenon. I don't know if again this explained it, but there are two different things going on here.
Yeah, I see where you're getting. By the way, Carver's book, the first one, Systematic Trading, is amazing. Is an amazing source of knowledge. I see where you're getting. Yeah, this thing of ergodicity is new to me, and I think there is something to it. I think there's this slow update of position size makes the game more ergodic. It turns the compounding effect in your favor, because compounding can be good when it's when it's going with you, but it can be really bad if markets move against you, and I think that's the link between. I think ergodicity is the link between these two things, the solution to this conundrum. But yeah, Thursday we can dig deeper in the nitty gritty of systematic trading.
Bruno, I think we need diversification. Yes, compound effect have some, but I think we need first of all diversification effect and harmful outliers. And I like your point. I like your position that compounded effect. I think it's in fact it's can play a role of anti-diversification effects, and we have seen this many times. And if we look at the chart, history chart, we can see this. For example, on COVID crisis 2020. And all the crises we see, like all instruments except commodities, and Niels taught me that except commodities, all instruments are going somewhere in one direction.
I was going to make that same point that about the pros and cons of compounding, and I think that when you're managing money and you're letting profits run in this particular strategy, you definitely want to be conservative with your money management, and the old turtle rule of cutting back quicker when you lose money and moving up your trading level, trade size as you make money, is a way to kind of cheat the system a bit and reduce your risk of ruin. And I think another thing too is that it's very, one of the big issues for me is just being consistent and having the same bet size all the time. And you want to eliminate the randomness of the trade level. And at some point, you've got to change it. You've got to increase it. You've made a bunch of money. We need to increase it. And so you're introducing your edge is having to deal with this randomness of, well, was it the right time? Now my new trades are going to be larger or smaller. Um, and it's this bet size. Once again, I'm betting, and I would prefer, as I've said, the way to get rid of all of this is at the end of every year, just distribute all the profits so your trade level stays constant. If you can handle a trade level that's the same for the entire year, where all the trades are treated the exact same, then distribute those profits at the end of the year and you're back to the same trade level. And so all of the trades are always traded the same way, the same size. So I think that's one way around this problem, because we don't really want this minor, even it's a minor part of our edge, to be impacted by the need to, at some point in time, start trading the next group of trades larger. I know some people even true up, like let's say on January the 1st, we have a new trade level, so let's increase all the old trades. So I would never do that. That's just too much going on there. Um, those trades were done the right way months or years ago, with the right size, with the right ATR, the right trade level. They're not to be touched again, of course, unless you have a client additions or redemptions. But um, I'm pretty sure at some point I got into that problem of truing up my trades at the end of the year.
So there's like one kind of middle of the road way that you can size in between using open equity and using closed equity, and you can use protected equity. So if you have any gains in open positions that are protected by a trailing exit, you can incorporate that equity into your sizing algorithm. But you have to use some kind of discrete exit signal, which not all systems do. So you need like a stated price to kind of set your equity against. If you use like a moving average crossover or something like that, you don't know where the exit's going to occur ahead of time, so you can't do that. But that's one thing you can look at. If you're trading a smaller account and you want to kind of make use of your protected equity to size your next trade a little bit bigger, but you're not sizing based on money that you won't necessarily hold on to.
Seth, one way to get to this number would be take your open equity and subtract that metric that Niels talks a lot about,
The heat.
the risk to stop. Sorry?
Yeah, the risk to stop, the heat of the portfolio,
The heat.
from the position to the trailing stop. You could use that trailing stop as your adjusted equity, as Steph's saying. Good idea, but that would therefore introduce compounding more frequently than for instance my conservative tolerance would like. But I totally agree with the principle.
Yeah, I like the word heat.
Well, once again, no, you have to ignore or minimize the issue that I brought up, which is um, the merit of each bet slash trade being put on with the same consistent trade level. And so if that doesn't bother you, it kind of bothers me. So it's not just um, not incorporating profits. And I think Richard does use his closed trade equity, which I've done all of those things. And I don't think it's subject to a back test necessarily. Um, it's more like theoretically and philosophically, how should you handle and what, as far as robustness and as risk of ruin, uh, because I think the back test will be a little unreliable. You could have, you can do. I've done things wrong before that are easily could be determined as wrong, and yet the back test did not alert me to that. And so, yeah, so I think I want to be very consistent. And okay, so after a big 40% move up, I'm looking. I've got to change my equity, my trade level soon, and that's a bummer. But the next trades for the next year or two, they'll be done at the same size, and I'll be very consistent with these bets and not get myself in a situation where my edge is eroded strictly because I put on losing trades, for instance, with a higher trade level. So I don't want that. I don't. And then if you do the back test with this periodic increase in trade level, you may say, oh, okay, I'm increasing trade level so slow it works, and it's really a good money management technique. But what I need to do now is trade my unit sizes need to be a bit bigger, because I'll have trades on that are a year or two old at an old trade level, and I'm not really making the money that I need to hit my target of 10 or 12 or 15%, or in Mulvaney's case, 50%, whatever. Um, so you'll see that in the back test as well. That okay, I'll trade a bit bigger because I'm slow to increase my trade.
No, but Jerry, you can see exactly in the back test, and it's all about ergodicity. Uh, Take this. I'll try. I'll do my best to 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 describe the example in Old Peter's paper. So an ergodic game would be take a coin, and if it flips head, you earn $50, and if it flips tails, you lose $40. So if you take this game once, twice, 3 times, 10 times in a row, the expectation is positive. With each coin, you're probably earning money. So if you flip the coin 100 times, you'll probably get rich, because at each coin you expect to earn $10. Now, change the game, and with each flipped coin, you either earn 50% or lose 40%. The expectation in each flip is still positive, but with two bad flips, you may lose a lot of money, and you may never recover it back, because you're earning so much less, uh, because you're just earning 50% with each coin. And if you lose, I don't know, 40% and then 40% again, the next win will be 50% of a really small amount. In this second game, ergodicity goes away. This is not an ergodic game, and that's why I think this is behind the slow sizing update. When you are slow to update, you're closer to an ergodic game. You just update your size once in a while, and each sequential bet you make, each sequential trade you make, they have the same positive expectation. Whereas in an extreme case where you update your trade size every day, one day can be fatal, and ruin your whole equity, because you've sized too large and lost, in my example, 40% with a single flip.
Yes, I agree. And my point was, having done that analysis that you've done and came to the correct point of view, even if the back test would tell me that it doesn't see the danger in updating every day, I still wouldn't do it. I would not rely upon the back test versus the analysis coming to the conclusion the way you came to it, irrespective of what the back test says. What you said is correct. It doesn't matter. The back test may fool you, depending upon how you do it and the time frame that you do it, and it may give you a false sense of security, which that's one of the reasons that I'm always skeptical of these back tests when it comes to calculations like this. I like the back test to say, hey, this breakout is good, this breakout exit is good, the stop loss is okay, but then I'm kind of done. I don't want to look at history, because the history of these back tests, 30 or 40 years is not enough.
Yeah, so this is a very good point, and thanks for saying that, because it completely puts that Rob versus Jerry debate to an end. I can see both philosophies very clearly, um, and you just said it. You don't believe that there's an ex ante reason to size position differently, because all positions have the same the same likelihood of realizing the ATR or not. The experience I've actually had, in my life is that this this is not true. I mean, like, sometimes trades go nowhere. Breakouts don't happen. Well, they happen, they come back, they get absorbed back. Sometimes, trends fail. Sometimes all sorts of things happen. So having a way to update your beliefs as you go along, and this is a very Bayesian sort of language because, it really has to be happening in a certain framework. You really have to have a certain machinery behind you to do it. It's actually what we should be doing. And we should be doing it. And again, back to your point, Jerry. So, I'm very conflicted in this, in choosing my philosophy. You have to do it only if you have the right tools, because doing it with standard deviation and using volatility, like, rolling volatility, is quite idiotic because it's like driving, looking at your rear view mirror and saying, okay, where am I going? Oh, I'm going where I've been, 2 seconds ago. And then before too long, you're going to hit something very nice, very white, and probably quite hard, which will cause you, to a sudden deceleration, which may cause injury. But the point is exactly like that, as you said it. I mean, this is where philosophies diverge. Maybe this is where our dialects start being different languages. But at the fundamental heart of this problem is how do we capture that non-linearity? You guys look back into something and say, oh, this pattern, this thing called the breakout over n days, is working because it's been working for ions for ages. And I'm saying, okay, can we do a bit better? Can we actually find signals that have a signaling value? And have I solved everything? No. Have I gone anywhere with it? Time will tell. But this is exactly the difference. And perhaps in your next, hopefully soon, showdown with Rob Carver, you guys should try and focus on this point and trying to sort of see how we could drive things forward and find that compromise if there is a compromise, or just declare the two approaches to be wholly incompatible.
Yeah, I think I can remember what I wanted to say, and that is that I agree with the first part you were saying, that there are differences. And I think whenever you observe these differences in markets and how they have up, it's not that you can deny, it's just that we have a built-in excuse, and that is we don't have enough data. So you think you're seeing these differences, and oh, they're there. You see them. It's just that unless we pretend to ourselves that, hey, all these markets are basically the same, and we're going to trade them all the same in the back test, use the same parameters. We're going to act like they're the same, have the same movement and personality and characteristics. If we don't do that, we can't get comfort. We can't get enough sample size of trades to go forward. Um, and another thing that we do is
That's very true, by the way.
we acknowledge that we don't really, we're always acknowledging we don't have enough data. And so that causes us, why not just trade system one? It's number one and it's performed the best. Well, because I don't think system one is necessarily, I'm not making a claim that system one is going to remain number one. So I've got 2, 3, 4, 5, 6, and 7 with slightly different parameters. And I keep repeating, the back test says they make the same amount of money. The trade stats are a bit different because the holding period is going to make the trade primarily be the reason that the trade stats are different. But we're hedging our bets. And you know what? In the final analysis, I didn't trade system 8, but system 8 ended up being the best one. And maybe my system 1 through 4 really, really underperformed. So it's just guesswork. We're awesome. We're awesome at getting in these trades. I mean, you hit that breakout. Yeah, we're awesome at it because we have 60% losing trades. We never miss a winning trade, but we're not very good at knowing what to do once we get that winning trade. And that thing is a tiger by the tail, and it takes off. And what should we do? Well, we've got these trailing stops, multiple trailing stops, and we have no clue which one is going to make the most amount of money on this trade or on all the trades put together.
We could sing a song there, though, Jerry, where we say you got to know when to hold them, know when to fold them, know when to walk away, and know when to run. So that's what I do as soon as I release a trade into the market. I know what my capital is. I protect my capital. So that's what I'm protecting. That's my defense. Then that trade that releases, I've got no idea where it's going to go, and that's my bet. So I just let it run. Wait until the dealing's done before you count your money. I think we can learn a lot from Kenny Rogers here.
As I said before, I want to say that, of course, it's we understand for all of us. I think we always have not enough data, and I also understand that I don't have enough data, and maybe it's impossible to have enough data. But we must understand how our system works, and I have a strong approach, a strong philosophy. I see strong philosophy in transforming trading, and I believe in transforming. I believe in the future of transforming. I believe in the past of transforming. So, and what is going on with this, I believe, and it's my point here.
Clubhouse needs a laugh button. So when Richard and I are telling these jokes, you guys can hit the laugh button, because for Richard and me, this we not only want to be right, we want to be funny, and I kind of want to be funny, mostly funny, versus not being versus being right. If I had to choose, I want to be funny. Um, but I think at the end of the day, people could look at track records and say, "Wow, you were really good. You just crushed it. How did you know?" And then I think the honest answer would be, look, all I knew was don't be convergent. That's all I knew. And if I am the lucky one who chose the parameters better than someone else, it was because I was the lucky one. But at least I knew to take small losses, and at least I knew to diversify, and at least I knew let those profits run and don't get on the side of convergence. So I think that's the game we're kind of playing. It's not, there is no finish line. There is no one to sit back and say, even ourselves, we're not going to ever sit back and say, really figured this game out.
Listening to you guys, Bruno and Jerry, kind of go back and forth and talk about kind of Rob's approach versus Jerry's approach, it makes me think that the classical approach is almost trying to prepare for the outlier that hasn't happened yet. And then kind of the more quant approach is trying to prepare with the outliers that have already occurred, being optimized for. I think the classical approach is completely open-ended. It's prepared for an ATR move that's incomprehensible, whereas an approach that uses vol targeting and resizes often, an approach that's willing to take profits off the table before your trend signal tells you, is more optimizing for the outliers that have already occurred. And I just had the thought, I wonder if you did an analysis in the crypto market with the trend following system, how different your optimization parameters would be, considering some of the humongous moves that have occurred in some of the crypto markets, not just Bitcoin and Ethereum, but there's some other ones that have moved, just as much or more. But just the thought there.
No, you nailed it. I think that is perfect. Yeah, because I've said to myself, like, I want to do a lot of back tests, but I want to take as little from them as possible. Here's a pretty good place to buy. Here's a pretty good place to sell. And here's a pretty good place to get out of a losing trade. And that's it. And that's exactly right. The future is unknowable. All I'm banking on is this trade sample size of thousands of trades is going, but more or less, it's going to do okay, and I'm going to, increase my odds by not putting all my eggs in one basket, but trading multiple entries and exits. So you're 100% right. I don't like that data. I don't. That history is going to steer me wrong. How can history steer you wrong when you're looking at history to determine your entries and exits? I mean, I don't know if I can articulate it, but it's the sample size. I'm only paying attention to um, this generic system that's applied to every market. But in the future, I expect the markets to be much different. The fundamentals, there will be new markets, there'll be markets that go away, and the future will look nothing like the past, except my average win, my average loss, my average trade, and hopefully my win percentage, my hit rate, will be similar, but then I would never look at crypto or any market, Bitcoin, Ethereum, or any market, and optimize a system based upon that. I trade Bitcoin and Ethereum futures, so they trade a systematic approach. They use parameters that are best for the whole portfolio: currencies, commodities, stocks, and bonds. So fine tuning a system for one market, I don't care if it's been around for 1,000 years, which crypto has not. And there's another issue, but no, you're getting this information. You're getting this max sample size by looking at all the markets and choosing parameters that look better on the group. Um, my my parameters for Bitcoin are probably very heavily influenced by the commodities and what worked best in the commodities. And I know that sounds pretty dumb, but I embrace that totally.
Yeah, my point more was not that you should optimize for any specific market or group of markets, but more, I wonder how much a quant trend following approach, how much the optimization would change if you included a lot of these crypto markets that have had bigger moves than have been seen in the rest of, I guess, the markets that have data that you can look back and back test on. And I think it would probably change a lot because there's been moves of such magnitude that I don't think have been prevalent in other markets.
Yeah, Seth,
Okay, so if
I hear
I
what you're saying. I'd say that what we're finding with quantitative approaches is this inevitable ability to bias results to an overfit result. What you're saying with our trend following methods is we anticipate the future being nothing like the past. So, in effect, we're underfitting our results. But what is best, overfitting or underfitting? And I'd say that, well, actually, underfitting. When we're dealing with these outliers that are anomalies, I say if we take too much influence on what the data is saying in the past, the vast majority of that data is noise and the vast majority of that data is convergent. The outliers are infrequent in nature, but they're huge in magnitude. So the magnitude actually biases results, but the frequency doesn't. So when we're looking at the data set if we're relying on the back test, we're going to be overfitting our results. And I think this loose pants phenomenon is we've actually they talk about optimally fitting or a moderate fit. Well, I actually think we need to be have low underfit. I think we need to underfit our models based on what the data has said. But risk management, the risk management side is where we have to take a stand and say, well, what is an appropriate level to set our stops? What is an appropriate level to set our trailing stops? Ultimately, we do have to use data as a basis to define, well, what has the history told us. But the open profit potential is totally undefined. So that's where we underfit our models. It's the profit side of the equation where we underfit our models, but we do need to draw a line in the sand over what is a reasonable stop level to cut our losses short. So that's how I view it.
okay, so Seth, a couple of, if I may, a couple of comments. First, I am privileged because I'm part of an exclusive club of one, and so I can't even count on Derek's support when I need him. By the way, that was intended for the laugh button. But the point
I
that
laughed.
Richard brings up, And the point that Richard brought up just now, he really stole my thunder. And I would contend that doing some sort of position management as market conditions change. And again, you have to be thinking that we are living in a Bayesian world where every time we get information, you update and you change your prior belief and it becomes a posterior distribution. If none of these makes sense to you, it's okay. But it means that every day the market, every day, Richard once again talks about reality being a gigantic Monte Carlo simulation where we see only one realization. And I totally subscribe to that point of view. So every time we get a data point, an observation, I go back at night, I fire off my, MCMC machine, figure out a new distribution of the world based on condition on what happened up until today. And I distill that number into that one measure that we call volatility. And yes, I agree, it's probably a misnomer. But that thing is my brakes, is my regularizing factor. I adjust my whole trading by that measure. And once again, we can talk about how quick, how much I compound. I don't compound daily. I don't compound gains. So all the things that you guys spoke about make a lot of sense. There's all sorts of non-symmetric compounding, but anyway, it sort of doesn't matter in terms of describing the philosophy. The philosophy is that I take a little bit of an issue in saying, oh, I'm the dumb guy that optimizes to yesterday's reality. No, I'm trying to sort of incorporate a little bit of evidence because we know that markets are autoregressive. Yes, they are mean reverting as well, but there's some memory in the process. So if something all of a sudden becomes more risky, I need to do something. I triggered Jerry once by saying that we need to hedge our profits when we need it the most. After a super long run, we should be trying to become a little bit more conservative with respect to one trade. And if we're doing really poorly, we should be super aggressive at cutting our losses. So my stops effectively become asymmetric as well as continuous. As I said, it's a bit more complicated than oh, you're using a volatility. I'm definitely not using value at risk if that's what some of you think. It's a bit more complicated, which is not complex. It's complicated. Complication and complexity are two different concepts. Complication is adding lots of layers of simplicity on top of one another, stack them up, and achieve something a bit better than just a simple thing. So yesterday, for example, we were talking about removing all the assumptions, just moving away from normal distributions and things like that. And I was kind of aggressive saying, well, do we really need to do that? Or and embrace a new world of nonlinear dynamics and very complex models? Or can we stay in something a bit more simple in terms of approach and add complications? So, I'm all about complications, not complexity. And I'm sorry, Seth, but I don't think I am optimizing for yesterday. I know the computers are great. I'm memorizing data. I don't care about that. I try not to overfit. I'm maniacal about not, adjusting parameters to what happened yesterday. I completely subscribe to Jerry's view that ex ante, we don't have an expectation of what the market delivers, but every day the market tells us how much volatility gets realized in each instrument, and that's important to me. And I think we could continue for days on end, but I think hopefully you understand where I'm coming from, and it's not about trying to kind of make sure that I build something that on paper looks fantastic, but in practice loses money.
I like what you say, Bruno, and I'll share my lunch with you. But look, I always thought that I was a weird guy, or Jerry was a weird guy, and that we had to drag a lot of people along with us. So it's interesting how we tend to pigeonhole ourselves. Like I actually don't believe you're as extreme as you might think you are, Bruno. So yeah, look, I really love this this sort of broad, diverse conversation because
Oh, it's wonderful.
it
I love
really
it. I
helps
love it.
us.
I
Yeah,
love to talk.
yeah, me too. So yeah, I'll share my lunch with you.
Yeah, me too. So I
Thank
yeah, I
you.
just wanted to make one thing clear is that I agree that when we have these big profits, I find it almost irresistible not to. I don't vol target because I don't care about I've said this before. I don't care about the volatility or the risk, but I do care about losing that money. So I do think that, and maybe this is something, this ergodicity, I can't really understand it totally. I think I did, and I don't understand totally this utility theory. We talked about that. That was a big Bill Eckhart thing. But I just assume that when we've made a ton of money in something, even though I may not be that concerned about the drawdown part of it, risk part of it, the denominator, I am concerned with the numerator, and I don't want to give all that profit back. So I talk a big game theoretically, but I don't really follow through 100% because I will take something off the table when the ATR is 10 or 20 times bigger than it was when I first put it on. Okay. But here's another thing I firmly believe as well. If you came up with a rule to do that, it would make less money than following the system where the trailing stop is far, far away. That's my guess. And I think I've
And
never
you're
been
right.
able to.
And you're absolutely right.
Yeah. So there is the problem, is that we're saying it's logical, it's reasonable, it's utility, it's all these terms. We're going to, it's December. I want to book 20% and not 15% for the year. We have all these real world concerns. We're humans, and yet we have no evidence that this no sample size, low sample size, discretionary move that might be rules based. Oh, it's a rule, but it's not a worthy rule because it's based upon outliers, and there's too few of them to justify a rule that singles out outliers. That we're going to do it anyways. And so, this is the human condition.
Look, just in relation to ergodicity, just as an example that sort of helps to explain it. So an ergodic system, a good example is when you fill smoke in a room. The smoke distributes right throughout the room. It touches all points in space within that room. That's an ergodic system. You can think of it in terms of time. So if you've got a system over a long period of time, then it moves to all points in that possible space over time. Or you can think of it, if you eliminate the time aspect, you can think of it touching all points in space at the same time, and that's the way statistics tends to work. So when you say there's a 40% probability or a 60% probability or something, you're thinking it in the context of an ergodic system where you've got total free range over a long enough time. A system will always reach the entire spatial domain of that probability distribution. But the reality is when we're dealing with things like wealth or finite things that then apply a probability to it, we're changing that space of possible states to a finite arrangement where you've got a constraint boundary on that finite arrangement. So if I've got $100,000 in a portfolio and I've got a probability of a win or a loss, I'm not just dealing with the probability of the win or a loss. I'm also looking at the state of my finite capital, the $100,000. And there's what they call an absorbing barrier that prevents that system, or it constrains that system to not actually allow that probability to achieve a move to all possible states. Because if you look at a probability, you think that it's symmetrically distributed either way to 100%, but that finite capital actually means that there is a zero risk of ruin, where suddenly you constrain the possible states that system can move. So that's a non-ergodic system. So we realize that in trading the financial markets, when we're dealing with finite investment capital, it's a non-ergodic process. There are constraint boundaries apply, which totally change this notion that price is free to move within any of these possible the probability domain, any of this possible state of spaces. So I just hope that explains things, because what that means is that path dependence is critical. How many outliers we've had in the past, what is the state of our drawdown, that changes the nature of our finite capital at all points in time. And every time that finite capital changes, it reduces that space of possible states. So it's fairly complex, but I hope that gives an idea of how to understand it.
Yeah, the concept is new to me also, Jerry. But one simple example I've heard that helped me understand is think of plane flights. If you take one flight, you're almost certainly okay, because the probability of the plane crash is really, really, really low. Now, if you take all the plane flights that happened through history, if you could possibly do that, you would be certainly dead, because it takes only one plane to crash to kill you. So that's the thing about path dependency. If one is enough to ruin you, the process is not ergodic.
Love it, Bruno.
Okay, can you quickly make a more obvious trading example of what you just?
Well,
Perhaps I can try something like that. It's if markets were ergodic, and we were to sort of Monte Carlo simulate them and say we have a market that has been realized in the past 5% or whatever it is with this kind of volatility, you just very quickly and very easily in an ergodic world can generate thousands of examples, and then make up your mind. This concept of an absorbing barrier is as such. If, however, when things go bad, you hit either a stop loss, or you consume all your capital, or your risk manager comes and tells you, you know what, I think your job is better served downstairs at the pub, either as a customer or as a barman, it doesn't matter, but you're out. All these kind of things force a change in people's behavior. And you can no longer repeat the experiment. So today you had a bad day. Well, guess what? It was your last day at the office. So you can't from there. That's what a non-ergodic situation would be. So Ole Peters takes issue at this concept of maximizing utility and all these abstract concepts that underpin economic theory and finance, and he's very right, by the way. And so he's saying basically we need to rebuild the whole math and tools that we use to measure how things work. Precisely because we don't live in a world where each number is equally realizable within the confine of your distribution. Distribution itself can hit the right tail and just that's it, and you don't get to play. You don't survive for another day. You don't live. You don't fight to you don't live to fight another day. That's the expression. That's a non-ergodic system, and that's in trading. Unfortunately, what's happening? All the major crises are like that. So hopefully that explains it. If not,
Yeah, very good. Thank you. Okay, I'm gonna have to sign off, and I can leave you guys on the stage to keep going. But it's been fun, and I look forward to doing it next week. And don't forget about Derek on Thursday. So everybody have a good weekend. Thank you.
Thanks, Jerry. Thanks, everyone. Goodbye.
thanks, everyone.